Stock markets 2018 May 1, 2018 10:35 a.m. Greenwich Mean Time. Buy submissions. Martin C. writes, in the latest week, the busiest for first quarter reports, several companies warned about or cited higher costs. Shares of all three companies declined even though their quarterly earnings were mostly strong. Investors will be alert for more signs of rising costs next week, which brings results from several big consumer names like Kellogg and market cap leader Apple. Also on tap will be a Federal Reserve meeting, the April jobs report and data on wages and inflation. In the face of it, the earnings for the first quarter of this year that companies have been announcing are superb and far ahead of the most optimistic expectations. A month ago, brokers were braced for an increase of 18.5%. The first quarter was the first reporting period since U.S. President Donald Trump in March imposed a duty on imports of steel and aluminum. Prices for those and other commodities have risen sharply, with U.S. crude oil up 7.5% in the first quarter. However, the earnings are incomplete, contrarian to actual economy, as we see below. The U.S. debt has stayed at high levels while the latest GDP numbers is weak in its details. Let's prepare ourselves for a buzzy trading week. U.S. debt, high. The debt-to-GDP ratio has stayed high at 105.4%. This is one of the most historically high debt that U.S. has carried for such a long period of time. It severely restricts the U.S. ability to dig out of a hole if the economy craters again. It is a very delicate situation. U.S. GDP, weakened details. The GDP came in at an annualized 2.3% on quarter in the first quarter of 2018, below 2.9% in the previous period but beating market expectations of 2%. Personal consumption expenditure, PCE, contributed 0.73 percentage points to growth, 2.75 percentage points in the previous period, and rose 1.1%, 4% in the previous period. Services, 2.1% compared to 2.3% in the previous period, and non-durables, 0.1% compared to 4.8%, slowed, and spending on durable goods shrank 3.3%, following a 13.7% rise in the previous quarter. Fixed investment added 0.76 percentage points to growth, 1.31 percentage points in the previous period, and increased 4.6%, 8.2% in the previous period. Investment slowed for equipment, 4.7% compared to 11.6%, and stalled for residential, 12.8% in the previous period. On the other hand, it rose faster for structures, 12.3% compared to 6.3%, and intellectual property products, 3.6% compared to 0.8%. Private inventories added 0.43 percentage points to growth after subtracting 0.53% in the previous period. Meanwhile, both exports, 4.8% compared to 7%, and imports, 2.6% compared to 14.1%, eased. As a result, the impact from trade was 0.2%, better than minus 1.16% in the previous period. Government spending and investment added 0.2 percentage points to growth, 0.51 percentage points in the previous period. It increased 1.2%, compared to 3%. Passenger car registration, 10-year lows. Passenger car registrations is often a keenly watched indicator because it gives the pulse of the economy. The trend shows the clear weakness in consumption across the U.S. While the last reading was a slick, car registrations in the United States increased to 431.32 thousand in February from 413.33 thousand in January of 2018. Car registrations in the United States averaged 698.18 thousand from 1975 until 2018, reaching an all-time high of 1149 thousand in September of 1986 and a record low of 331.50 thousand in January of 2009. DAX, a major warning. The DAX is under the 200 DMA for over 4 weeks. No recovery attempted. This clearly is suggesting market is not done with the correction. There's more coming. We see a potential drop of 5% at the minimum and possibly well over 10% as well. The U.S. Large Cap Index has breached the 200 DMA at 2,587 and the recovery has been limited under the 50 DMA. The index has again fallen under 2,670 levels. We see fast-paced correction. EUR/USD, stalled downward move? EUR/USD is not falling as expected. There is only one explanation for the stalled downward move. It will move higher to 1.2250 before moving to 1.26. The year carry trade is unwinding as ECB removes the stimulus. Spread, recession ahead? The spread of the 10 halves is falling and nearing the zero mark. At zero, the curve would have inverted, which is an accurate signal for future recession. US 10Y yield, fake breakout. US 10Y yield after hitting 3.05 has fallen well under 3% mark. We see this as a fake breakout and hence the next target is to 5% dollar index, following the 10-year yield. Dollar index rally was based on US 10Y breakout above 3%. The yield has now fallen into 2.95%. Dollar index will follow. Summary: the economy in the US has suddenly plateaued off. This is exactly what has happened in the EU. However, the US has very little wiggle room as the debt stands at 105% of GDP. They cannot allow 10Y to go higher, nor can they do more stimulus. Things are getting tighter for US. If the market senses the danger ahead as economy craters and the fiscal situation worsens, it is the end of the bull run as we know it. By Martin C. http://livemarkets.live about livemarkets.live. Livemarkets.live runs a highly successful trading and investment management program along with high-quality premium research. Our automated trading system has run since 2009. Every single month has made positive returns. Clients with MT4 terminal can take advantage of this system. Please contact us at investment@livemarkets.live. Copyright 2018 Martin C. All rights reserved. Disclaimer: the above is a matter of opinion provided for general information purposes only and is not intended as investment advice. Information and analysis above are derived from sources and utilizing methods believed to be reliable, but we cannot accept responsibility for any losses you may incur as a result of this analysis. Individuals should consult with their personal financial advisors. Copyright 2005 to 2018 http://www.marketoracle.co.uk. The Market Oracle is a free daily financial markets analysis. Only logged-in users are allowed to post comments. Register, log in,